This fuel's for you. The Excise Tax Podcast. Your host.
That's Petroleum Pat, and I'm Butane Brian, and we're here to continue discussing fuel excise taxes.
You know, I find it interesting. We're in podcast 3, and we've only covered one tax. Just to briefly recap, when crude oil reaches the refinery, it's taxed at 8 cents per barrel of crude, which isn't much. It's called the fossil tax, the Federal Oil Spill Liability Trust Fund tax, and it's the first step in the taxing process. We are now at a point where we're dealing with the actual products. We have intrepid chemists who masterfully blend liquids, primarily gasoline and diesel, together to form the products that you use in your car. And we noted that these products are precisely designed and must meet standards as developed by the ASTM, American Society of Testing Engineers, or Testing Materials, which is a group of engineers who write the standards that the products must meet. And we have a product. Let's call it gasoline. We have a gallon of gasoline that is freshly minted from the raw products of butane and refined gasoline and a little bit of naphtha and a little bit of whatever else the engineers and chemists decide makes this the ultimate fuel for your car. It is sitting in a tank, and a tank is in the refinery. Excise tax is interesting in that it is a tax that happens not because fuel is sold, purchased, or otherwise transferred entirely. The tax happens because of some physical event.
Yeah, usually you have to have a taxable event or some sort of transaction.
Absolutely. In the world of sales taxes, which everybody is familiar with, you walk up to the clerk, you hand him the item, he rings it up. He says, this will be $10 and an additional 75 cents in sales tax. The sales tax doesn't happen until you actually make the purchase. This is not true in the world of fuel taxes. The government has decided that the best point in the process to tax fuel is when it leaves the manufacturer's facility. And they thought that was a little cumbersome, so they expanded the definition to the terminal bulk fuel system. And the terminal bulk system is composed of the system of refineries, pipelines, and storage terminals, which are used by the industry. Also thrown in there are vessels used to move the product on the waterways and oceans that get the product from point A to point B.
So it's taxed when it comes off the vessel, or it's taxed when it goes through the pipeline to the end?
Very good question. We're getting into the whole point of the whole incidence of taxation.
Because in the history of taxation, there are some things that are not fair. Like a farmer might have a whole field full of crops that's very valuable, but he doesn't have any money because it hasn't been sold yet. So it's reasonable to wait until he sells it before collecting the tax.
A great question, and this really dovetails into the history of excise taxes. This is exactly the scenario that was considered way back in the golden age or the dark ages of taxation, however you want to look at it, when the question is we don't know whether this fuel is going to be used for a taxable or non-taxable use, and farmers being a special group, the taxation was said, well, we don't want to be taxing the farmers because then we're taxing our food, that type of thing. If the farmer has to pay a tax on his tractor fuel, then essentially we're taxing the growing of the crops. And there were a lot of different exemptions available to a lot of different groups. However, over the years, and so the logical point of taxation was at the distributor level, when you're dealing with the person who actually is selling the fuel, then that person can say, okay, Brian, you are an exempt person. I won't charge you the tax. And Joe, you are a taxable person. I'll charge you the tax. And that comes with one very inherent problem.
Well, yes, it makes the distributor kind of in charge of enforcing it.
Absolutely. And that's the key point. How do you tell whether Brian, the non-taxable person, really bought 1 million gallons of fuel, or whether the distributor is just saying that Brian bought the 100 million gallons of fuel, and the record keeping is a complete nightmare. And it's also subject to tremendous abuse. The governments didn't like this, especially the federal government, and they said, we have to have a better way to control this because we can't tell what's going on. So they pushed the point of taxation away from the seller back to the removal from the terminal bulk system. So when fuel leaves, not transfers within, but leaves the terminal bulk system, then it is subject to tax.
Okay. Where are the endpoints of the terminal bulk system? Is there like several in every state? Or are they at the ends of pipelines or something like that?
That is a great question. The typical process, we'll use a pipeline example because it's easiest to visualize in your head. You have crude oil coming into a refinery. The refinery makes the products that we use. They create a tank of diesel, a tank of jet fuel, a tank of gasoline, and then they will store this fuel in the tank until it's ready to be shipped. The most efficient and effective way to move large quantities of petroleum products is via pipeline. So the refinery will then make nominations on the pipeline saying, on Tuesday we want to ship 1 million gallons of jet fuel, 2 million gallons of diesel fuel, and 3 million gallons of gasoline. And the pipeline says, okay, we will accept that fuel into our pipeline and then move it along the way for distribution. So a refinery is part of the terminal bulk system. The pipeline is part of the terminal bulk system. And the product then moves along all within the terminal bulk system until it reaches a delivery point, which by definition which includes the terminal, hence the name, the terminal bulk delivery system. The terminal is a receiving point, and what makes a terminal in IRS eyes is the fact that it receives product via pipeline or via vessel, meaning a barge or a freighter.
Okay, from pipeline then to the smaller truck that goes on the road, or the ship then to the smaller truck that goes on the road.
And that's a good point. There's a lot of terminology that has been built into this process that dates back more than 100 years. The common terminology is that when fuel is behind the rack, it is not taxable. A related term is when fuel is above the rack, it's not taxable. And those seem like nonsensical statements if you don't know what a rack is. In simplest terms, a rack is a point where a nozzled hose will allow you to remove fuel from a large bulk storage tank and place it into either the fuel tank of a vehicle or into a delivery tank of
Or a rail car?
A rail car, a highway truck are two good examples. So a rack is the simplest rack that everybody deals with every day is the gas station where you fill up your car. That's a rack.
Oh, okay.
The term above the rack dates back to the days before pumps were in common use. When you think about this, it took me a long time to understand this term until one day I was driving along and I saw a visual site that made it all apparent. I was driving out in the country, and I noticed that there was a tank up on stilts. It was about 6 to 8 feet above the ground, and it was obviously a tank of fuel used to fuel the farmers' tractors and equipment. And it's a simple tank with a hose on it. There was no pump. So by lowering the hose and opening the nozzle, the fuel would naturally flow by gravity from the tank above the ground into the vehicle resting on the ground. So the tank was above the rack being the nozzle.
Okay, I get it.
And it's one of those concepts that didn't make any sense to me until I saw the visual. And then I started looking around and saw more examples of that. So the concept is the same when you talk about behind the rack when you get into the world of pumps. And now, since you aren't dependent on gravity to move the fuel out of the tank into the vehicle, and you can move a pump, it's just behind the rack, meaning it's in the storage tank.
Okay. You have the rack, and you got the hose and the nozzle, and you've got the guy there who collects the money. Now, how does that work? He collects the tax from you, and then he sends it to the federal government?
Great question. No. The issue there is that it matters not who is selling the fuel from behind the rack and who is buying the fuel on the other side of the rack. The issue is that the fuel has moved from behind the rack across the rack or below the rack, meaning that it has been removed from the terminal system. The IRS uses the term terminal removal to indicate a taxable event. And that means any way that you physically move fuel from one side of the rack to the other, from behind the rack to across the rack. And it doesn't matter who owns the fuel, because it only matters who owns the fuel behind the rack, because they are responsible for reporting it, whether or not they're selling it or whether they're just transferring it to their own
So there's
inventory.
no money that changes hands necessarely. That's just the taxable event created right there by the movement of the fuel.
Right. So if I'm just moving, I've got 1 million gallons in a tank that I want to move 10,000 gallons to my gas station down the street, I have removed it from the terminal and I'm putting it in my gas station. I now owe the government tax on 10,000 gallons.
I get it.
And that is the key point of the modern tax system, is taxing it at the terminal, because there's only a couple of thousand, or there's not even a couple of thousand terminals. There's a very limited number of terminals and refineries, all of which are registered with the Internal Revenue Service.
Do you just fill out an IRS form with the number of gallons on it?
Now we're getting into the actual tax return preparation process, which we will cover in detail at a later point. But essentially that, each month, each quarter, the person who is liable for the tax, be a position holder, and we'll get into position holder, each quarter the person who is liable for the tax will report to the IRS that they have distributed taxable gallons of gasoline, diesel, and jet fuel, and report the appropriate amount of tax on each volume. The excise tax return is interesting in that some people argue that each line on the tax return and the Form 720 tax return represents an individual income tax or individual tax return in its own right. I don't know if I quite follow that theory, but it makes some sense when you start thinking about it, because each line is specifically numbered with the IRS and they track those quantities.
Now, after it leaves the rack, do you still have to keep track of like individual loads or anything, or is it all just interchangeable after that?
It becomes very interesting because now you're getting into the realm of state taxes. and the states are all over the place on where it's taxable.
Oh, no.
Oh, yes. Because, as I like to say, each state has the best way of taxing fuel. Just ask them, because that's what they'll do. And in reality, what you're dealing with when you're dealing with fuel is, if you move fuel between states, it's just like importing and exporting from one country to another. The information has to be recorded. The taxes appropriately have to be paid, or refund sought for taxes paid in the originating state, and it becomes a real interesting problem of tracking.
Oh, okay. So I understand it now. Is that that's the end of the federal tax portion, and then you have to the character of the fuel changes, whether it's for on-road use or off-road use, something like that?
Well, I want to correct you, Brian. It's not the end of the federal tax scenario. The tax has been imposed on the fuel. That doesn't mean that the appropriate tax has been paid, or the appropriate amount of tax has been incurred. That's a better way to put it.
Oh, because we still don't know if it's going to be taxable fuel yet.
Absolutely. There are two scenarios in the federal tax environment. There are customer exemptions, meaning that because of my status as a entity, I am not subject to tax. And then there's a use exemption, and that is because the fuel was consumed for a certain use, it becomes taxable at a lower rate or exempt from tax.
What are some of the entities that are exempt?
The exempt entities are, of course, the United States military, not the United States government, the United States military. And they are only exempt for the federal excise tax. Let me back up a little bit. We haven't talked about tax rates, but there is a partial exemption for the military. And that may be a good point to segue into the taxable rates on fuel, if you'd like.
Yeah, let's do that.
This could go long.
It's okay.
The taxes that apply, and I'm going to get a little technical here. If you're interested in looking at the tax rates, you go to the Internal Revenue Code. Section 4081 covers the tax rates that are applicable on motor fuels. Diesel, aviation, gasoline, kerosene, kerosene used in aviation, and fuel used with ethanol.
Oh, okay. Those are the big four.
Yes. See, I covered that. The rate on gasoline for use in motor vehicles on the highway is 18.3 cents per gallon for the federal excise tax. In addition, there is 1/10 of a cent a gallon leaking underground storage tank, or as the joke in the industry is, there's a lust tax, and you never thought the government would be able to tax that.
L-U-S-T.
Leaking underground storage tank. Yes. So that's the way the tax is built, is that there's a component, there's a federal excise tax component, and there's a lust component. So for diesel fuel is taxed at 24.4 cents per gallon if it's clear fuel. And that's made up of 24.3 federal excise tax and 1/10 of a cent for lust tax. Recognizing that there is a lot of use of fuel that is exempt, for example, construction equipment and agricultural equipment, is only subject to the 1/10 of a cent lust tax. They allow the addition of dye to red dye is added to diesel fuel and kerosene, and that fuel can be removed from the terminal, and it is subject only to the 1/10 of a cent per gallon, and that can be used by people who are using off-road equipment and farm equipment. And the penalties are for using, because the question comes in right away, what's to prevent Joe truck driver from pulling up his big rig and saying, fill me up with the dyed cheap gas, because that's 24.3 cents a gallon, and when you're filling up 200 gallons, that adds up really quick, or more gallons into your truck, that adds up really quick. So there's a lot of incentive for people to buy dyed fuel because it's a lot cheaper. Well, the reason that they dye the fuel is because it is now marked, and it is very easy to determine whether a person is using fuel inappropriately. One, you take the cap off the tank, the gas tank, and you look, and you can literally see that it's got a red tint to it. Or they've got test strips that you poke in and it absorbs the dye, and immediately you can tell that there's dyed fuel in the tank. The government wants to discourage that, and they will issue severe fines, and $10 per gallon of dyed fuel is a fine that is on the books.
That could add up
very quickly. 100 gallons at $10 a gallon is $1,000. Plus, the states use the same system in a lot of ways, and they will layer their own fines on top of this, and this can get real ugly real quick. So I segued into dyed fuel a little bit. It's the same fuel as regular fuel. Regular fuel is called clear fuel, hence because there's no red dye in it. But regular fuel is also colored. For example, kerosene is straw colored, and that's
Is that a natural color or a dye?
That's some of each.
Oh.
Gasoline has a blue color to it, and I'm not sure what diesel is. Diesel, I think, has a little green hint to it. We were talking about tax rates. The diesel fuel rate is 24.4 when you combine the two taxes. Kerosene, which can be used to thin diesel, kerosene is lighter than most diesel products and can be added to diesel and burned in trucks. Back in the under the old scenario years ago, kerosene was not taxed because it was not considered to be a highway fuel, because it was used in kerosene heaters for industrial and home use. So it was sold tax-free because those are tax-free events. But as the old agents used to say, all you do is add a quart of oil to 50 gallons of kerosene and you've got diesel.
Just add a quart of oil to 50 gallons of kerosene, you got diesel. I'll remember that one.
It may come in handy someday. And that gives you the sufficient lubrication. And that's another segue too, is that diesel fuel, when spilled on a surface, is very slippery because it's got the lubrication in it. Kerosene spilled under the same surface is not nearly as slippery because it doesn't have the lubrication built in it. So we covered diesel fuel. Let's cover gasoline. Gasoline is, for motor vehicle use, is taxed at 18.3 cents a gallon federal excise tax and 1/10 cent lust. Aviation gasoline is taxed at 19.3 cents per gallon and the lust for a total of 19.4. Now we get into kerosene for use in aviation, and that is a defined term by the IRS. Kerosene used in aircraft turbines.
This is basically all your big jets and stuff. So we're talking mostly kerosene for the aviation industry.
Yes, kerosene. all jet fuel is kerosene, but not all kerosene is jet fuel is the standard. Jet fuel must meet standards that are higher than kerosene in cleanliness and moisture content because of the nature of jet aircraft. And I didn't think about this until I started talking to some pilots, and it all of a sudden became glaringly obvious. An aircraft sitting on the airport runway will be in 80, 90 degree temperature. 20 minutes later, after it takes off and climbs to altitude, it's now at 40 below zero. So if you have a turbine fuel that has too much moisture in it, it will make the jet fuel gel.
Oh, okay.
Which means it doesn't flow through the fuel pumps very well.
No.
Which means your engines don't work very well, and bad things happen. So that's little things like that. When you think about what we ask some of our fuels to do, things like having a 130 degree temperature change in just a few minutes, it's really quite remarkable. And I don't think I could do that.
Biodiesel will gel unless you add stuff to it.
We will cover biodiesel at a later time. By definition, and here's where your ASTM standards come in, if you have a product that is diesel fuel, or you have a product that is jet turbine fuel, or you have a product that is gasoline, it is gasoline, it is turbine fuel, it is diesel fuel, because it meets all the standards. The only thing about biofuel is that it has come from a different feedstock. It comes from oil from palm trees or oil from coconuts or whatever, as opposed to crude oil, but it still meets the ASTM standards.
Okay.
Which I find kind of humorous because, what have we really gained? We're still burning oil. It's just happened to be that it started out as coconut oil as opposed to petroleum oil. And that's a good point for a break. We'll pick up on tax rates when it really gets interesting here in the next episode.
That's the end of this episode. For show notes and links, just search for the Fuel Excise Tax Podcast or the Journal of Recreational Accounting. Google knows where to find us.